And I'm very, very excited today to have a friend of mine on with me. His name is Ryan Leahy, and Ryan is somebody who is actually a competitor of mine. We have been for a long time. And I've always admired him and his business model from kind of afar. We've never worked together. And you're probably saying, well, why would you bring your competition on your own show? I said, well, because Ryan's going to talk about something that's brand new to the market that he's bringing out that could make you lots of money and save you lots of money as well. So I'm going to let him kind of step in and talk about, because I saw him speak in front of a group about 2 weeks ago or so, a week ago, and I was like, wow, I've got to get Ryan on this show because we want to partner up a little bit and share this message with our audience today and others on Facebook or YouTube or whatnot, because this is important. And so you take it away about your background, and then we'll start talking about your program.
Yeah, Mark, thanks so much for having me on here. It was great to see you at the presentation. And you and I are veterans in the business. We've been now at it for longer than 20 years, and 37 for you. I'm 22. Yeah, so
you're a baby. Man.
Yeah, I'm still a pup. So it is really an honor to be sitting across from you. You were also a mentor, kind of somebody I watched from afar as I was getting into the business, and so it is real neat how this all comes full circle.
This is fabulous.
A little serendipity there, right?
Yeah, that's right. So, that's right. We can always learn from each other.
Most certainly.
And I always say that when I bring a guest on, I'm also here to learn.
Most certainly.
Not just talk, so what you have to say is important. So you guys, stop what you're doing and listen to this man.
Yeah. Thank you. Thank you. I really think it is about collaboration today, and it is about being creative in today's market.
Mm-hmm.
Austin did see one of the fastest appreciations in the country for the last 4 to 5 years. And so with that, we also saw a slowdown that led the country as well. That's so we had the hockey stick on the way up, and we also had the hockey stick on the way down.
I think we're sort of down to the balanced market.
I do think we have balanced out. I do.
We're
seeing a lot of activity pick up, particularly over the last several weeks, and sellers are realistic and buyers are being realistic now. And so I do think that the market has balanced out. Interestingly enough, I saw yesterday that Redfin put out that Austin was the most was the number one city that had improved in affordability throughout the entire country. So we've had the most correction in prices, I would say, across the country, which again, we have, what we're so blessed about in Austin is we have highly qualified buyers.
That's right.
Because we have also the number one job market in the country.
That's right.
And so they're just sitting on the fence waiting for the terms that are going to make sense to them.
Yeah.
So we decided to figure out a program. How do we help people get off the fence?
Mm-hmm.
How do we help them with that dream home that they're coming across? They're highly qualified, and they're just like, it just doesn't make sense for me to move forward today.
Mm-hmm.
How do we help that come forward? And so we built a program from the ground up that uncovers that and really gives sellers and buyers a chance to actually come together in a way that we don't think has really been done, most certainly in the last 20 years.
I've never seen it. And we want to explore that today, because I'm going to kind of break it down to where it's manageable to people to understand. Because as an example, I have several homes in Austin, and 2 of them have loan rates under 3%.
Yeah.
And now so you want to talk about that and how I may even use that program myself, possibly.
Most certainly. It is interesting. So what we built was called the More Loan Program. So MORE, capital MORE. And
that's more money.
Yeah, more money. Yeah, you got
it. Some more money.
Let's do it. Show me the money. But yes, it's about getting more out of your house, get more out of your loan, get more money. Because what is it? It's
more opportunities for people.
You got it. More opportunities. Because what is it really about? At the end of the day, it is about money.
Right.
It is about the sellers getting the number that they need.
That's right.
So that they can move on, just emotionally and because they have a number in their mind,
and financially,
so that they can actually transact on the next house or whatever they're going to do.
Right.
And then for the buyers, it's about money.
Right.
It's about saving that monthly payment. It's about that down payment that makes the most sense for their month to equal a monthly payment that their household can substantiate.
Sure.
And with the preconceived notions of the fear of loss, or actually not fear of loss, but the loss that people did when they didn't get those 3% rates and they did sit on the fence and they couldn't get into the home market for whatever reason or chose not to. Now we were in a spot to figure out how to help them do that. So So long story short, what we did is we built a program that shows sellers that they actually have two assets.
Okay.
And then for the first time in my career, this has been a substantial part of the market. And what are the two assets? Obviously, they have a home. That's the first asset that all agents are trained on, and you and I are trained on to help maximize for our clients.
That's right.
But the other asset that hasn't existed in your and my entire career is having where the large majority, over 60% of the clients that have a mortgage have an interest rate below 4%.
60%?
60%.
Wow, it's amazing.
So, and by the way, here in Austin, Texas, and the Austin Metroplex, 50% of the homeowners own the houses cash.
Really?
That's correct. So
there's a lot of equity in this town.
There's a tremendous amount of money and equity in this town.
And I've never thought about the loan being an asset.
Yeah.
See, that's where you really opened my eyes to. I'm saying, wow, that's really interesting way of positioning it. That your mortgage, if it's a good rate, is an asset to you.
It really is.
You know,
I mean, think of it. Where else, in what time frame are we ever going to get a 30-year fixed mortgage at 3% or 3.5% or 2.875%? That's a massive asset. And what's incredible to me is people aren't looking at it as an asset. They haven't been educated as an asset, and it is not just an asset. It's a very, very valuable asset.
Mm-hmm. Absolutely.
And so we built the proprietary calculators.
And typically, they're not $50,000 loans. They're $400,000, $500,000, or whatever
on $1 million properties.
Exactly.
And so, what does everybody have? What do sellers have? They have low interest rates or a lot of equity. What do buyers want? Low interest rates.
Yeah.
So we started creating a matching program on really what does that look like. And so, before I'm going to throw it out there, the term, and it's generally known as like a kind of an icky term that people really associate. A lot of them will hear this term and they're immediately going to turn off. And I'm going to ask all your listeners out here to keep an open mind, because we have approached this from several different angles, and we partnered with a law firm that's been doing these types of loans for more than 15 years and has done over 10,000 of them. So I would like for everybody to hear a little bit about the program before I kind of unwrap it. And so what it ultimately is, it's a seller financing program.
Okay.
And when most people hear seller financing, probably half of your audience just immediately turned off and was like, I'm not listening anymore.
Right.
What I would encourage them is that if we can show you as a seller a way to get the cash in hand that you need, actually show you how to get a much lower down payment on your next home, not lower down payment, lower interest rate on your next home,
right,
and have a hassle-free process, would you be open to doing seller financing?
I would.
But
raise my hand.
But to a highly qualified buyer.
Yes.
That's the caveat on our program versus the other seller financing programs that are out there.
Yep.
So let's unpack that. Let's start with the highly qualified
and
buyer.
What I really learned from you today is such a win-win-win. Everybody's going to win in this deal. And I'm not kidding.
Yeah, no, it really is. It's spectacular. It is a win-win-win program. It's a win for the seller, a win for the buyers, a win for the agents to be able to represent to solve the frustration that their sellers are receiving and that their buyers have. And so that's really where we've come together and brought this program. It takes some creative thinking.
Absolutely.
But we've ironed out throughout the last 6 months, we've spent tackling this program from every objection and every angle that we've received in our beta testing, and we've built a solution for each and every one of them to where it's really a
Let's
smooth
unpack
program.
a little bit.
Yeah, thank you. So what that looks like is on the seller financing. Let's speak about who we're seller financing to.
Okay,
these are very highly qualified buyers. These are not people that don't qualify for a mortgage.
That's right. Which is normally what a seller finance is.
That's right.
Somebody who just can't get a traditional loan.
That's right. And there's this really bad stigma out there, and it does hold to be true. It's funny thing about stereotypes is there's always a grain of truth to a lot of stereotypes. Now they generally can get blown out of proportion, but seller financing people, general sellers that have great credit and have been financially responsible throughout most of their life, they think that people that do seller financing or a buyer that needs seller financing is not a good candidate to sell their home to.
Right.
Now, again, that's not this program. So this program is going after that person that works at Google or at Facebook or is, again, a highly qualified buyer. Good credit,
money in the bank.
exactly, long job history, all of those things that a bank would lend on.
Right.
And we are now helping the seller dollarize their current mortgage. So how do we show you as a seller? You have a 3% mortgage right now on so a $400,000 mortgage at 3% on $1 million property. Okay.
That's a good example right there.
It really is. It's amazing how often we run across this exact scenario.
Right.
You have a buyer that you have your home on the market. It's been on the market longer than 60 days, longer than 90 days. You're not getting the offers or the traction. Why is that? Your house is nice. It's fixed up. It fits all of the, checks all the boxes, and your agent's scratching their head going, I don't know.
Right.
So your only options you're left for with marketing your property is to cut the price. Right. Well, that's like catching a falling knife. You never know how far to cut, how deep to cut. Is it a timing thing? Is it just, what is it? And so that's a really difficult game to play. And once you really start showing your hand,
an expensive game too.
Thank you. Yeah, inexpensive. And once you start dropping your price, the buyers all know, well, hey, that person's shown that they're willing to drop their price 2 times over the last 60 days. They're
going really low now.
That's right. Yeah. We're desperate.
Right.
They're desperate. So yeah, we're going to really, get the best deal.
Right.
And that's not a good place to negotiate from. So negotiating from a point of weakness.
Yeah.
So ultimately, where we're showing this is how do we help the sellers get a higher price? But the way that they're going to get that higher price is they're going to extend a better terms on a mortgage. As you know, rates as of a month ago were touching 8%.
That's right.
Thank goodness we're not there anymore.
Right. They have floated back down a little bit.
Yeah,
sure.
We're in the mid sixes to high sixes for somebody that's putting 25% down.
Right.
And I think that's also part of people see the interest rates online, mid sixes with points. You can get into the low sixes. You can get 6% with a couple of points now. If they're putting 20% down, it's a 3/8 hit to a half hit to the rate.
Right.
If you're putting less than that, it goes up from there. So most of the public doesn't also have access to these lower rates. So making their 3% mortgage on $400,000 even more valuable. So what we're looking to do is we find buyers that are willing to get pre-approved with us on our and what we do is we work directly with the sellers. So we let everybody know we are here to help sellers market their home. Usually the listing agent brings us in so far, because that's been who we've been marketing to, saying, let us help solve the solutions for your sellers. Let us provide solutions for your sellers on houses that aren't moving. And way we're going to do that is we're going to offer a 2-point, but really interest rate below 2 points below the market. 1.5 to 2 points. So we're showing sellers how to monetize their 3% interest rate to getting 4.875, 4.75%.
That's negotiable.
And it's 100% negotiable.
They create that themselves.
That's correct. Well, we built a bunch of proprietary calculators, and we back into how much the seller needs to make their next transaction. So how much cash in hand do you need?
Okay.
And
you want to sell your house for $1 million.
Right.
And you owe 400.
That's right.
Okay.
So how much down payment are we going to require?
They need the whole 6. This probably wouldn't work.
That's correct. These are definitely designed for sellers that are willing to leave some equity in their home.
Got it.
So generally they're going to need somewhere between 20 and 25% for their next transaction to put down. So we back into whatever that number is.
Okay.
Let's
say it's 250.
Okay. So let's say it's 250. So your seller is going to we would guide the seller that they're going to offer seller financing so that they will be able to net that 250.
Got it.
Now, here's what's really interesting about seller financing. The more that you require down, the less people you're attracting. Right?
That's right.
So here's also what's interesting about it. We're able to, when a buyer comes in and is pre-approved through us, and they're coming in through the seller financing. So when a seller goes through the program, we're walking them through the entire program, and we're letting them know that this is a marketing tool. What's really interesting, first and foremost, we're casting a wide net and a different net than currently has been cast by the listing agent. What I mean by that is what happens, or would your home stand out amongst all the other homes in the $1 million price point if your home had a 4.75% interest rate attached to it? Absolutely. It's going to be $1,600 a month cheaper than the 6.5% interest rate.
Yep.
So your home most certainly is going to stand out now. So that's going to attract buyers. So what we work on with is when a buyer comes in, are they most certainly going to do a seller financing transaction? The answer is no, not necessarily. More than 80% of the time on the transactions that we've closed, our buyers end up we work with the seller so the buyers actually end up with a conventional financing loan.
Okay.
So we're utilizing the seller financing because what we're able to do is we're able to work directly with the seller and directly with the buyer. And that's a unique part of our process.
Okay.
We don't represent, remember, Mark, there's no new loan in
Yeah.
a seller financing transaction. You and I are not originating a new loan.
That's
There's
right.
no processing.
There's no underwriting.
There's no underwriting.
Yep.
So you don't have those risks or those costs.
Right.
And so what
you
happens,
close them quick too.
Yeah, and we can close in
It's
less
not
than
30 days.
Yeah, it's 14 days.
Right.
Yeah, and usually 10 business days, and it can be done in 7. So
and maybe not even appraisal.
And usually no appraisal is required,
right,
unless the buyer just wants one.
Right.
And so that's also a really powerful part of the program as you get rid of all the red tape because nobody likes the loan process.
We know about red tape.
Yeah, we definitely do know about red tape. So nobody likes the loan process. So the other part about this is, so we represent the transaction.
Yeah,
we don't represent the seller. We don't represent
kind
the
of
buyer.
a middleman.
We represent, that's right,
if you will.
And so what's really interesting, it's a consulting role. What's really interesting about this is that you and I always have to go through the agents in order to try to get our client to get a deal accepted, right? So if we're representing the buyer in a traditional transaction, we give our buyer's agent the pre-approval letter. Our buyer's agent presents that as the best light and strongest case that they can for their buyer. And then, of course, you and I generally call the listing agent and say, hey, look, they're good. This is all that we've done. Try to help them set apart. In this circumstance, because the listing agents introduced me directly to the seller, and we always have a call with the listing agent when we're talking to the seller on the phone, as we never, ever mention price. That's between the seller and the listing agent. But our job is to bring the transaction together through the other terms. What are the terms? The interest rate and the length of time, as well as we have deferred payment options. We can create anything that the seller and the buyer want to bring the transaction together.
Right.
What's really interesting about this is I'm the one, and my team is directly talking to the seller and directly talking to the buyer. There's not an agent that's that's in the middle of the game of telephone that's going to keep things from happening. So once a buyer comes in and they're highly qualified, we verified they're highly qualified, we're going to go to the seller and say, okay, Mr. and Mrs. Seller, you put this out here as seller financing is an interest rate in the high 4s. Let's say 4.75% for your home, and you're requiring $300,000 down. And we'll get into how the down payment pays the agents in a moment. But that down payment now is going to pay for all the transactions. The down payment from the buyer is going to pay for all the transaction
just like a normal
costs.
Down payment would, basically.
Absolutely. Yeah. Just like when you sell a home, you're going to pay your agents and the title and everything else. And so what's left after paying the transaction costs is what the seller keeps.
Right.
Cash in hand.
Right. Nets.
Thank you. And so now what we're going to be able to do is show the seller how to make a monthly income off of, let's say the buyer, as you mentioned, is putting $250,000 down or $300,000 down in this case, so the seller can net $250,000. And so the seller now is going to create a loan for a total loan amount of $700,000.
Right.
So they have a loan for $400,000 at 3%.
Okay.
Now they have a second lien position at 4.75 for $300,000.
Okay.
For a net total of $700,000.
Okay.
Now, what's interesting about this is,
so it's not a wrap.
It is. It functions like a wrap.
Yeah.
So our program is different than a wrap because it doesn't trigger the due on sale clause the exact same way.
Okay.
And so
it's actually a second lien.
So it's actually not. So what we do is we do.
See, I'm here to learn.
Yeah, you're here to learn. So we're going to create one individual lien for $700,000 over the entire program for 4.75.
Okay.
Then we bring in a servicing company that's been doing this for years and years and years. The buyer makes a payment to the servicing company. The servicing company then pays, let's say Wells Fargo is who their current loan is with.
The 3% loan or
the
whatever.
3%
the underlying loan.
The underlying loan. Right. They make that payment to Wells Fargo. Then the seller gets paid the other $1,700 a month for the 1.5%. Remember, because they're charging 700,000 at 4.75. So they're making 1.75% arbitrage spread on the first loan of the 400. That's right.
Basically a bank.
You're being a bank
for
your own home. What's fascinating about this is you're going to be able to, let's say that the seller agrees to a 3-year term. And let's just say, for easy math in this circumstance, the seller's going to be making $2,000 extra per month on a 4.75% interest rate that they did for the buyer.
Got it.
That's going to be 24 grand more per year times 3 years. Let's just say that the seller and buyer agree to do a 3-year term. That's $72,000 more that home sold for.
Yeah.
So it didn't sell for $1 million. It sold for $1,072,000.
Yeah.
That's right.
Yeah.
Now, the buyer can refinance at any point in time.
Okay.
Just like they can with the bank.
Prepayment penalty?
No prepayment
penalty. You could
penalty.
create one, though, if you wanted to.
The seller absolutely can.
You could.
And we've had a seller do it.
Yeah.
Saying, hey, look, if you want this interest rate, then I need you to keep the loan for 2 years.
Yeah.
And we go back and forth. And so what's really unique is we created proprietary calculators, to show the benefit to the buyer and the benefit to the seller, because it always has to be a win-win.
Yeah.
In order for the deal to come together.
Yeah.
And because we represent the transaction, I've had several conversations with sellers saying, you know what, you're being greedy. That's not going to work for this buyer. If you want to run this buyer off, then put those terms out. Do you want to keep the deal together, or do you want to run it off? Well, Ryan, what do you suggest? Because I'm not willing to do what. And so we'll make some suggestions, because again, I've spoken personally with the buyer, have them pre-approved, have all their finances. Now, as part of that, we're there to put the deal together, and it's been wildly successful. We've rolled it out. Really, December 5th was our first rollout, and
just a few weeks ago.
Yeah, just a few weeks ago.
Yeah.
And we've got about 30 homes. So listing agents brought us to their sellers, and the sellers have enrolled in the program, and we've given the listing agent the specific language to market the seller financing that gets the most hits. We had people do a lot of research on exactly what that looks like to attract the most buyers. And then we start that process. But what I would go back to is it's really a big marketing program, because out of the transactions we've closed, more than 80% end up with a conventional financing offer.
Why would they do conventional financing at the higher rates?
So remember, they're pre-approved.
Yeah.
So here's what's really neat. When we have them pre-approved and we start talking to the seller, and I say, Mr. Seller, Mr. and Mrs. Seller, look, you can make that extra $72,000 over 3 years like we discussed.
Yeah.
And have some of the risks that go along with doing this. Or we've got them pre-approved. Let's just look at a permanent buy down and see what that looks like. And you as Mr. and Mrs. Seller can weigh out, let me just run those numbers for you, and weigh out bird in hand today or bird in hand over 3 years.
Yeah. You take your 600 off the table today, or take some today and then wait for the rest of it.
That's exactly right. Yeah. And so when you come back to the seller and look at them and say, hey, look, your time value of money, it's pretty simple. Take 600 and drop it in at 5% in their money market account or wherever you want to put it, right? Their time value of money generally comes out higher if they just go ahead and offer the buyer a permanent buy down.
Yeah, that makes sense. That makes a lot of sense.
So, hey, you know what? You can go ahead and offer the buyer to pay the buyer's buy down for $22,000, and we can arrive at the same interest rate.
Yeah.
And so
you mentioned a little bit about risk. Let's talk about the risk a little bit.
Yeah.
What is the risk?
Yeah, there's 3 risks to this that we've solved for. So the first risk is credit risk.
Okay.
What happens if the buyer doesn't pay the monthly mortgage?
That's a problem.
It's a problem. Yeah, particularly because now what do you do? You're stuck with both payments as a seller, right? So first off, we identify what the servicing company is going to call the buyer and find out, is it a temporary problem or is it a permanent problem? If it's a temporary problem, what does that look like? And when can they get caught up? If it's a permanent problem, we're going to, all of these generally are written with deed in lieu of foreclosure available. Now, deed in lieu of foreclosure has some challenges being enforced in the state of Texas, but generally it can also, it can still keep the deal together and make it all happen. So that's part of these transactions. So when the buyer hits certain triggers, the deed in lieu of foreclosure kicks in.
Just like on a mortgage.
On a mortgage, except for you just don't have to go through the foreclosure process.
That's right.
And go in front of the judge and those types of things. So you have the deed in lieu of foreclosure as the first protection to get them out. But let's talk about the credit risk. In the event that happens, the sellers can buy what we call a buyer assurance, a surety program.
Okay.
And what that
like
is,
insurance.
it's like insurance,
Okay.
but we call it a surety because we're not licensed in insurance.
Right.
But the seller can buy an insurance program where we will step in and make that payment.
Okay.
On behalf of the seller, if the seller can't go ahead and make that payment themselves.
Okay.
So we figured that piece out. The second piece is your property risk. What's the condition for the property in the event you do have to kick them out? Did they let all the landscaping go? Does it just need a touch up between paint and carpet, or do we have to rip out all the wood floors because they just destroyed them with their dog and
like a
running
bad
around
tenant
the house?
would, or
Right, like a bad tenant would.
Yeah,
That's right. So there's companies like Curbio and all of these different companies that'll come in and fix up that house to make it however you want it, and then they don't even bill you, and they just bill it as long as the home is going to be listed. They'll just put their loan with the title company, their invoice with the title company.
Right.
So that's another great way to satisfy that piece. And the last risk on it is what's called due on sale clause risk. And so I'm flying through these because we've got not a ton of time left. Yeah. But
maybe do part 2 someday.
Yeah, right. So the due on sale clause, the large majority of this is not an assumable loan product. This is not that. We are performing in effect something similar to a wrap. Except for our due on sale clause, we built a solution into it that you got to pay to play. If you want that, because we spent a lot of time coming up with a very specific circumstance that solves what's called the due on sale clause in the language. And so we call it, that's our proprietary information at this juncture.
That's awesome.
That the law firm and the trust attorneys have all figured out on how to come together.
We've only got a minute or so, a few seconds. This went by fast, man. So tell the people how to get a hold of you.
You bet.
So I'm going to partner with you on some of these.
Yeah, we've got a great affiliate program you and I've talked about. And so it's called the More Loan Program. So they can go to Leahy Lending. That's LEAHY lending.com and then /more. Or they can just Google the More, MORE loan program.
Okay.
And Ken Knight is our client success manager, and he'll set up the call, and the sellers can all go through the quick little questionnaire and upload their current mortgage statement, and we can see what we can do for them.
Well, guys, that was a lot of fun. I really enjoyed being with you, Ryan, and learning some new things myself and how we can continue to support this market we're in.
Absolutely.
So
thanks so much for having me.
You
Absolutely,
bet,
Mark.
All right.
Appreciate you.
Again.